Stephen Mitchell. Welcome to the Broker Room podcast, mate.
Great, thank you for having me, Mark.
So you're the CEO of Oak Capital, OAK Capital. Just tell us a little bit about Oak Capital, and then we're going to just push in a little bit into the sorts of stuff that you guys specialise in. But like, who is Oak Capital? Yep. You know, who sits behind it, where to come from, maybe where its funding comes from, etc.
Yeah, sure. So look, I set up Oak Capital with a number of partners back in 2013. Prior to that, I had a business going in the name of Resicom, which I set up in 2006. So Resicom was a mortgage management company and always specialised in that second tier space. So clients with defaults, self-employed, low doc, all that sort of space. I continued that business till late last year. And alongside that, Oak was growing. And it set up essentially as a private mortgage fund initially. And over the course of sort of 8 years, I bought out a number of partners. And late last year, I bought out the final partner. And in doing so, we did a relaunch and a rebranding. And we've sort of set ourselves up as the alternative non-bank lender. And the Resicom business was amalgamated into that at that time. So at the moment, we hit the market, and from a broker perspective, they can come to us for our own funded products, which is ultimately funded by investors. So we run a retail mortgage fund and also a wholesale mortgage fund. And we still maintain that legacy Resicom business, which is mortgage management. So we have two other mainstream funders out there that we rebrand their product and sell. So brokers are coming to us essentially as soon as they have a loan that doesn't fit bank criteria, and even slightly on the edge of even the standard second tiers out there. If you talk Latrobe, Bluestone, Liberty, and the brokers that need a bit more of that commercial common sense looking at a deal.
And we're talking about just resi or commercial and resi? So
all of our borrowers are generally all commercial borrowers.
Yep.
The asset class is all real estate, Australia-wide, resi, commercial, industrial, vacant land. The main thing we stay away from is that development space. That's not really our play. We're there more to solve an issue, a 12-month bridge type facility as a rule, where the client has, say, an ATO issue they need to resolve, or they've even done a purchase and a bank's let them down, they need to settle in 5 days' time. So they come to us, they solve a problem, and then they should move on in that sort of 12-month space. And we may even move them into one of our managed products in 12 months' time, where obviously interest rates get a bit cheaper, and then they ultimately go back to the bank. That's kind of that rehabilitation process that we hope that the borrowers go through.
Well, I guess with these things, it's better to look at scenarios. But let's say we've got a male, 65 years of age, wants to buy a property in this big Ballina which has shops downstairs and
Yep.
one or two apartment upstairs.
Yep.
Maybe strata, maybe it's not strated, but his income's pretty good. He has 20% deposit, but because of his age, he might the exit strategy might be just a bit complicated for the banks.
Yep.
You know how these things work. Is that a sort of deal? Is that what you look at? I'm not saying you'd approve it, but was that what we're talking about here? If I'm a broker, is that the sort of deal I go to with?
So that client would absolutely fit with us, except the LVR position. So with our own fund, we're generally 65%, 2/3 sort of lending as a rule.
Yep.
But then we do have the mortgage management stuff that pushes a bit harder. But that client would come to us, they'd probably have a commercial structure, company structure, he's self-employed. At his age of 65, we wouldn't have any concern. We would look at the exit and say, well, what is your plan? He might say, I'm going to do up the assets and then flog them off in 5 years' time. That would
Yep.
be perfectly logical for us. So that would be a deal. Probably the majority of ours would be, a developer who's got residual stock, needs some cash out to move on to his next project while he sells down over 12 months. Or a client who has some sort of credit impairment, or a creditor pressing them like the ATO, which we think we're going to see a lot more of next year.
Really?
The ATO hasn't been very active in the last 18 months because of COVID, but post-federal election, we believe they're going to start coming after the people that owe them some cash. So we'll see those deals again. Clients that might have an insolvent event on a company, which is still going through the process, doesn't affect the structure and the borrower we're dealing with, but a bank and even second tiers just can't get their head around that. So we can, because it doesn't have an effect on their current structure, and providing it makes sense, we'll look at doing a deal there as well. So a whole range of reasons of why borrowers are coming to us, but they're all self-employed and they need someone to look at their deal on a more bespoke arrangement.
Yeah, so you're positioned Oak Capital one rung after perhaps Liberty and Bluestone, etc. Maybe
Correct.
one rung further down the track.
Yep.
And it could be any of the sorts of things that they ordinarily would look at. You probably, but I think what you're saying though is, if I'm a broker, you're saying to me is that, Mark, my LVR, or so the amount of equity that the borrower's got to have is probably a bit more than 80%. So yeah, it's got to be, yeah, it's less than. We're not going to lend like you would lend on a resi borrower, where we're borrowing 20, they're borrowing 80% and putting up 20%.
Yeah, so
I mean, that makes sense.
Most of these clients are asset rich. They've got something else going
Yeah.
on. So they're normally got
Yeah.
a bit of equity there, or even in another asset that we can lean on. So we might go higher on the LVR because we can put a hold on another asset that's got a bit of equity in it as well. So we can be creative with how we structure the security position.
Yeah, and do you find in terms of the term of the loan, your borrowers, I mean, do you just say, oh, there's a 20-year loan, or are you saying it's a 10-year loan with an amortizer on it, or there's a 2-year loan and it's interest only and you've got to get out at the end of 2 years? I mean, what's the structure look like?
So with our own fund products, which is the majority of what we write, they're 12-month deals and occasionally 24 months. So if the deal's really good, we'll do 24, but we want to see the clients come, resolve whatever the issue is, and move on. We are a shorter term player. We've often been asked to do longer deals, but it just doesn't fit our model. And also, when you're paying a rate above where Latrobe and Liberty and, as you said, all those players are, you shouldn't want to stay there much longer than 12 or 24 months. Otherwise, something doesn't add up about your exit plan. So that's where we play and come and facilitate that shorter term position for them.
You're sort of like I don't want to put you into a position, but you're like a bit of a bridger. You're gonna bridge me out for a period of time whilst I get my shit together and resolve whatever it is I'm trying to resolve. And in terms of, are you looking at interest only or over that 2-year period? No, I wouldn't have thought so. No, it does make sense. Risk. Yeah. So that's interesting what you said about. I mean, whilst you don't fund a developer to do a development during the building stage, if a developer walks along there and they got a rump left in their last development of 10 apartments, and in order to start up their development funding from their bank, for example, they have to sell those or refinance those 12 apartments that sit at the back of the deal. You guys will fund those 12 apartments, for example, and they pay back the bank, then they can start all over again and go back and they can keep their cycle going. Yeah. Totally. That's very interesting because, I mean, especially with the example you just gave us about developers. I mean, if a developer's on a project for 2 years and they've sold, 80%, if they've got 20% left, the value of those remaining apartments probably gone up quite substantially anyway. So just by nature of the way the markets happen to work recently. And so they'd be in a good position to pay out whatever it is they borrowed against the original cost to the bank. So it makes sense. I mean, it gets them onto the next project quickly. And the banks are happy too because they're getting their money out. They're happy. They don't give a shit where the money comes from. If it comes from Oak Capital, they're happy enough. I mean, give me my money. Move on again. And you're seeing a bit of demand there, are you? Yeah. Mate, look at my fucking hair. I got mental. Yeah, yeah. So if I'm a broker, how do I find you? Like, I mean, do you have a team of BDMs floating around, or do I just get onto your website and you've got a call center? How's that work? Yeah, so like, let's say Stephen and I got a deal. It's Friday afternoon, client's panicking, and it's not a bank deal, and it might be just sitting on the edge of the usual names in the let's call it the non-conformers or the orthodox. How would I get onto you? Like, not to you, but or to you, but how do I get onto you? Just go on your website. Do you have a list of names I can ring? Is there phone numbers there, mobile numbers? How do you flow? Right. Yeah. Totally. And also, someone's going to hold the hand of the deal, right through to a yes or a no in the beginning. Like, you're not someone who's got. It's not like you're one of the big guys, the majors who've got 50 deals in front of them, and everyone's yelling and screaming at them. At the same brokers especially. And do you guys do? I presume you'll be at our conference in January, I think it is, or February, whenever we got our conference coming up, February. But do PD days for people in Sydney, for argument's sake? I mean, will you be doing those next year? Yep. Yep. But I love the fact that people like Oak is doing this sort of stuff. You feel a big gap in the marketplace. Not necessarily in terms of transactions, but it's a big gap it's a yawning chasm in terms of where banks might go. And in fact, even some of the second tier guys don't really want to go there either. But these doesn't mean the borrower's a shit borrower. I mean, the borrower could be a good borrower. And yeah, and that's what I'm hearing generally speaking. Those types of borrowers, generally speaking, are pretty attentive. They're not, and yet, by the way, you're not going to lend them the money if they're got no intention of repaying you or going to create you a problem anyway. And you've got enough LVR in there to make it work. I mean, you're sort of pretty safe. Relatively speaking, you're in safe territory, I would have thought. I mean, that's how it seems to me. So you would call yourselves a private lender, I presume. You're a non-bank lender, but a private lender. Yeah. 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 Yeah, maybe you're a private non-bank, which is a PNB. And I actually think that's a pretty cool position. It sounds like something out of Switzerland, and you got some, like, I mean, by the way, Morgan Stanley or Goldman Sachs were exactly that. And in fact, Goldman Sachs still has, as does Morgan Grenfell, their regional office, which is just up from 58th in New York, on the corner there. It's a little shop front. Looks like a retail shop, and has the signage out the front. But these things, they go back 100 years. I've seen them, and that's exactly what these organisations did, which one day now become, they're global businesses, obviously. We're talking about hundreds and probably trillions of dollars in terms of what they're doing around the world. And that's how they started. So for me, there's no stigma attached to a private non-bank. For me, they fill an important role. There are borrowers who still need to borrow money from people like your organisation. There are brokers, by the way, who need to get themselves familiarised with making sure that their borrowers know where to go if something does go astray. There's no reason why someone else shouldn't have a second chance if some life event occurs, whether it's a tax office or whatever it is, that they shouldn't get an opportunity to dig their way out of it with a good deal. And that's very interesting. We're going to have to finish up, but I think what you said, Stephen, was very interesting just then, because I think a lot of brokers, particularly the less experienced ones, don't know when to invest time in a borrower, your type of borrower. They don't know whether to invest the time in them. Sometimes they get emotional because they really want to help the borrower because they like them, but they overinvest. And sometimes they also go the other way. Sometimes they don't know enough about the borrower and they underinvest when it could have been a deal, and which means it could have been a commission paid, and which means mortgage brokers need to get their head around efficiency of time, and that's about understanding scenarios and understanding who to talk to at a place like Oak, or if it's at Liberty, or if it's at First Bank, wherever it is. You've got to understand what the products are, who's the person I can talk to, and what time of day can I talk to that individual, to work out whether I should be underinvesting or overinvesting my time. If it's underinvesting, that means I shouldn't underinvest. I should get out of this deal because it's not going to happen, but I'm not the one who can make the decision. Maybe Oak Capital can tell me straight up. And then tear your way down, or tear your way up. Like Liberty might say, no, shit, I better ring Oak. And know what the tiering is. And so it's about time efficiency and getting to go to your PD days, getting to meet your team, and understanding the scenario basis. And so I really appreciate your time, Stephen. It's been important for me to get familiar with your sorts of products, because I think our broker room is an attempt to talk to as many brokers as possible, particularly the younger ones and inexperienced ones, about what they can offer their clients and how they can become better in their business as being in the business of being a broker. That is, understanding what's available. To some extent, to be frank with you, Oak Capital is inventory for the broker, and it costs me nothing except my time. Which means that they save time on stuffing around with something. Steve, thanks very much. I really appreciate your time, and I'll see you next year at one of our events. Thanks, mate.